Hello and welcome. Thanks for joining us today. My name is Nick Perry with Creative Insurance Partners, and let's go on and get started. Today we're going to be discussing single premium life insurance products. We're going to talk about the different types of problems SPLI products can solve, and we're going to talk about how we as agents can market and sell SPLIs, both to our existing books of business and to brand new clients as well. And throughout the course of the webinar, we're also going to try to address the question of why we should be marketing these products. There's been a lot of innovation in the SPLI market, especially in the single premium indexed life insurance market. A lot of new products have come around that weren't available just a few years ago. Today we're able to service clients in a broad variety of personal financial situations and health conditions. There's better underwriting available. There's just a lot of great stuff going on in the SPLI market. There's a lot of reasons to be excited about this type of product. And not a lot of agents are offering them or making them a cornerstone of their portfolio. And by the end of today's webinar, you may be asking yourself why that's the case, because these products, they look really good. But before I get too far ahead of myself, let's take a step back and talk more about how these products work. Single premium life. The name tells you a lot about what's happening here. These are paid-up life insurance policies offered in exchange for a single upfront premium payment. So you pay once and you're done. No ongoing contributions or anything like that. Your initial premium is put in, and you get all of the benefits of that policy from day one. Things like 100% liquidity, high accumulation potential in comparison to other deposit products, and the traditional benefits of a life insurance policy. There's a lot of good stuff going on inside single premium life policies, so let's kind of break it out into some talking points that we might be able to use with our clients either in one-on-one appointments or during a seminar presentation. Number one, SPLIs are life insurance, single premium life insurance policies, right? That means we can transfer assets to heirs, income tax-free upon death, and immediately leverage our initial premium deposit to increase the size of that inheritance. In other words, they're excellent wealth transfer vehicles. If we've got somebody who has money in the bank, and they're saying, well, we're going to leave this to the kids, or we're going to leave this to a charity, or whatever, a single premium life insurance policy might be something that's very attractive to them because it's going to immediately increase the size of that legacy they're leaving. They may see twice as much or more in terms of the power of their premium dollar, putting in 50 grand and getting 100 grand or more in terms of death benefit. If the purposes of that money is already to create a legacy for another generation or for, like we said, a charity or something, a college, something like that, then this type of wealth transfer vehicle is extremely effective. It can also reduce volatility. Indexed life products remove downside exposure to market volatility when you compare it to other products, and they still historically boast better returns than traditional fixed products like CDs or multi-year guarantee annuities. So if you've got clients who are more directly invested into the market and they want to reduce their exposure to that market and to the volatility that brings, index products might be very attractive for them. Now, make sure you've got the proper licenses, of course, before you start telling somebody to sell all of their stock portfolio to buy an SPLI. But in general, the saying goes, you've got two guarantees with the market. It'll go up and it'll go down. Index products are really cool because when the market goes up, they go up. When the market goes down, they just stay there. Most of them have a 0% floor. So they provide excellent downside protection against that sort of market volatility while still capturing the upside peaks. We'll talk a little bit more about that later with some real number examples. But just to speak in generalities, clients who may feel overexposed to the market and who want to reduce the amount of volatility that they're experiencing with their investments may be interested in something like a single premium life insurance policy to solve that sort of problem. You still get great returns, you get that downside protection, and the liquidity is still there. And that brings us to our third talking point. These products can provide excellent liquidity. Now, because they're single premium products, they are modified endowment contracts, and that has a few consequences for our ability to take money out early in the policy life and what happens as far as the tax advantage status of that money. We'll talk about that in a little more detail later. For right now, the money, just know that the money inside these policies, it's accessible, but these policies really shine when you're talking about using them to help hedge against the potential costs of terminal illnesses, chronic illnesses, or skilled or extended nursing care or long-term care needs. A lot of these products offer excellent living benefit riders that allow you to accelerate that death benefit in the event of a number of different health events. things that cause the need for skilled or extended nursing care, or terminal illnesses or chronic illnesses. Because you're accelerating the death benefit to pay for these things instead of taking out of the cash value, that means our clients are getting to take advantage of that premium multiplier we talked about earlier. $1 of premium is going to equal much more than $1 of death benefit. And because we're accelerating our death benefit here to pay for these costs of terminal illnesses or whatever, we're getting a lot more bang for our buck than we would have had we just left that money in the bank and said, well, just in case. Leaving 20 grand, 50 grand, 100 grand in the bank and saying, this is here, this is our nest egg just in case we need long-term care, just in case we have, somebody gets diagnosed with cancer in the family and we need a little extra cash. That's great. That doing something like that puts you way ahead of most people. But if that's what that money is there for, it's going to be much more powerful in providing for those needs inside a single premium life insurance policy. And you're going to get all the other benefits of the policies that we're talking about as well. Let's take a look at a hypothetical example that kind of illustrates with real numbers how this policy, or a policy like this, can help somebody named Marie. Marie is our 60-year-old female non-smoker who has $100,000 sitting in the bank, and she wants to do something with it. And whatever that something is, it needs to accomplish two goals. Number one, it needs to give Marie some peace of mind about the possibility of health-related expenses during her lifetime. She's worried about getting sick and going broke. She doesn't want to have to sell everything she owns just to be able to pay for long-term care. And number two, she wants to maximize her inheritance to her grandchildren. $100,000 is a good chunk of money, but Marie knows that by the time that gets from her estate to her grandkids, Uncle Sam is going to have put his hand in the pot and taken his more than fair share out. So we want to try to avoid that if we can, and maybe grow that $100,000 into something a little bit bigger for the kids too. So let's see what would happen to Marie's $100,000 deposit inside a CD paying 2% a year, an annuity paying 3% a year, and a single premium life insurance product, this Wealth Horizon Life product through Equitrust. We'll take a look at how that plays out under a couple of different scenarios. Number one, let's say Marie passes away, so we're looking at the inheritance to her grandchildren. Well, if she passes away immediately, fairly soon after purchasing one of these products, CD, annuity, or SPLI, the SPLI is going to obviously come out as a clear winner. When you look at a CD or an annuity, the benefit there is that your money is going to sit and grow interest, and it's going to grow slowly over time as that interest accumulates. If you pass away immediately, no time has passed, and there was no accumulation potential realized there. The single premium life insurance product, on the other hand, you've got that immediate upfront benefit. You put your premium dollar in, and right away it's leveraged into a higher death benefit, and you get that extra bang for your buck. So even if Marie passes away immediately, that $100,000 is still turned into, in this case, $207,000 of death benefit, and that's a big inheritance to her grandkids, more than double what it would have been in either of the other products, or just sitting in the bank. And let's not forget about the tax advantage status as well. Even if Marie passes away 10 years down the line or 20 years down the line, and that CD or that annuity has had 10 or 20 years of accumulation, we're still a long way off from hitting what we would hit with the SPLI in terms of death benefit. The annuity at 3% after 20 years is still almost $50,000 short of what the SPLI can offer. So at 80 years old, if Marie was concerned primarily about the death benefit to her grandkids, even at 20 years out, the SPLI is still the clear winner. But Marie's primary concern was health-related expenses during her lifetime, remember. So let's see how the SPLI stacks up there. Now, let's say Marie runs into some health problems at age 70. So her money has been in one of these products now for 10 years. In a CD, after 10 years, we're looking at about $115,768. That's 10 years of accumulation on that $100,000 at 2%. And this assumes less taxes paid each year, of course. Our after-tax benefit in the annuity is going to be $124,762. But remember, with our Wealth Horizon Life product, we're able to accelerate our death benefit, take advantage of that premium multiplier, and you can see for a terminal illness, we're looking at a upfront benefit of $196,400. Nursing care confinement, we get a total benefit of $206,750. That's paid over 36 months. And our chronic care is the same benefit, $206,750, paid over 60 months. So in this scenario too, across the board, our SPLI wins out. It provides stronger living benefits, stronger accumulation, and stronger death benefit potential for our clients when compared to these other two products that we looked at here. So did our single premium life insurance policy do a good job of taking care of Marie's concerns? Well, I think so. In the scenario where Marie passed away and triggered that inheritance to her grandkids, her $100,000 deposit more than doubled in power to a $207,000 income tax-free death benefit. It blew away the competition. The CD and annuity just couldn't compete there. And Marie got to enjoy a lifetime peace of mind protection against the potential costs of health-related expenses like long-term care or cancer. And that's big. That's really big. Even though she didn't need this benefit in scenario one, just having it there is a great thing. That means Marie's no longer going to have to put money away just in case this sort of thing happens. The life insurance policy has that covered now. It means Marie is not going to go into a situation where, she's got a chest pain all of a sudden. Let's get to the doctor. Let's worry about that. Let's worry about our health. Not what might happen a week from now. Oh, what if this is the big one and I got to be in nursing care? Let's pile on another, 10 tons of financial stress on top of it. No. The ability to just focus on health and getting better and not having to worry about that financial stress during times of illness is pretty powerful. Anyone who's had family or friends or maybe themselves who have been through that sort of thing can definitely understand how financial stress can compound health-related stress. Protecting yourself, protecting your clients against that, great thing. And SPLI does a very good job of doing that. Number two, what if we had to tap into that benefit? We had some health troubles and Marie needed to access the money in her policy to take care of the costs of skilled nursing care, provide for money for a chronic illness or terminal illness, things like that. Well, we saw that $100,000 deposit become anywhere from $196,400 to $206,750 worth of benefit. Again, a big premium multiplier. Our client was able to access those benefits while avoiding the potential early withdrawal penalties we see in products like CDs and annuities. And because we're accelerating a death benefit, instead of taking out policy loans or withdrawing from something like a CD or annuity, those accelerated death benefits may be income tax-free. So across the board, we're getting more money and we're paying less taxes on it. I think that's a win. So did our single premium life insurance policy do a good job of taking care of Marie's concerns? Well, I think so. In the scenario where Marie passed away and triggered that inheritance to her grandkids, her $100,000 deposit more than doubled in power to a $207,000 income tax-free death benefit. It blew away the competition. The CD and annuity just couldn't compete there. And Marie got to enjoy a lifetime peace of mind protection against the potential costs of health-related expenses like long-term care or cancer. And that's big. That's really big. Even though she didn't need this benefit in scenario one, just having it there is a great thing. That means Marie's no longer going to have to put money away just in case this sort of thing happens. The life insurance policy has that covered now. It means Marie is not going to go into a situation where, she's got a chest pain all of a sudden. Let's get to the doctor. Let's worry about that. Let's worry about our health. Not what might happen a week from now. Oh, what if this is the big one and I got to be in nursing care? Let's pile on another, 10 tons of financial stress on top of it. No. The ability to just focus on health and getting better and not having to worry about that financial stress during times of illness is pretty powerful. Anyone who's had family or friends or maybe themselves who have been through that sort of thing can definitely understand how financial stress can compound health-related stress. Protecting yourself, protecting your clients against that, great thing. And SPLI does a very good job of doing that. Number two, what if we had to tap into that benefit? We had some health troubles and Marie needed to access the money in her policy to take care of the costs of skilled nursing care, provide for money for a chronic illness or terminal illness, things like that. Well, we saw that $100,000 deposit become anywhere from $196,400 to $206,750 worth of benefit. Again, a big premium multiplier. Our client was able to access those benefits while avoiding the potential early withdrawal penalties we see in products like CDs and annuities. And because we're accelerating a death benefit, instead of taking out policy loans or withdrawing from something like a CD or annuity, those accelerated death benefits may be income tax-free. So across the board, we're getting more money and we're paying less taxes on it. I think that's a win. And I think it's a win for us too, as the agent here. Marie seems like a nice lady. I'm glad to have her as a client. Now, we mentioned something about CDs and annuities that I want to go back to for a moment. We talked about how trying to access the money inside those types of contracts can result in early withdrawal penalties or surrender penalties. And this is probably a good time to talk about what happens when we try to access the cash value inside an SPLI. Because these policies are paid for with a single upfront premium, they're always going to be modified endowment contracts. And that means two things in terms of the cash value of the policy. Number one, any distributions of gains from the cash value are going to be taxable as income. And because this is a modified endowment contract, those distributions are going to come on a last in, first out basis. In other words, gains are going to come out first, gains are going to be taxable, so those for early distributions are going to create taxable events. And early withdrawals before age 59 and a half are going to be subject to a 10% withholding from the IRS as well. So these are two things to keep in mind when we're talking about the liquidity of the cash value in an SPLI. Before age 59 and a half, you've got that 10% penalty, and those gains are going to create taxable events as they're distributed. A lot of the liquidity stuff we've been talking about throughout the webinar up to now has been in terms of using the money in the policy to pay for long-term care events, to pay for terminal illnesses or chronic illnesses. Those types of benefits are paid for through an acceleration of the death benefit, and even though we're talking about a modified endowment contract now instead of a true life insurance policy, the death benefit still enjoys that same tax-advantaged status. We're going to get those benefits income tax-free. With a modified endowment contract, these distribution of gains and last in, first out and penalty, that all comes into play when we're trying to access the cash value of the policy directly. When we're using one of these living benefits riders to accelerate our death benefit, that stuff doesn't really come into play. And that's why I'm such a fan of these, what I like to call liquidity boosters. Things like these living benefits that we've been talking about that allow our clients to more easily access more of their money at less of a penalty. You see things like the living benefits we've talked about. You see things like National Western has a return of premium guarantee on their policy. You can just call them up and get your money back if you want, minus any distributions or loans. And there's very few strings attached there. And you see that sort of innovation more and more in the SPLI market. This is a type of product that's becoming more popular and that's seeing more growth and that's seeing more attention from carriers who are trying to make it better and better. And we as agents can reap the rewards of that. But, if you put liquidity aside for a second, what if we don't access the money in there? What if we just leave it in the policy and let it grow? Well, these are mostly equity index policies. An equity index product is not a direct investment in any index or in any stock. It's its own thing. An equity index product is going to see interest credited to the cash value based on the performance of an associated index. So for example, say you've got an equity index product linked to the S&P 500. That index goes up, we go up with it. That index goes down. Typically what happens is nothing. We just see a 0% interest credited. That's called a 0% floor, and that's a really powerful tool. It means that in years where the markets are down, we don't go down with them. In years where the markets are up, we get to rise with them. So we participate in the gains and sit out the losses, which is pretty neat. Let's take a look at how something like that might have worked during a time of great volatility, the Great Depression. Our 0% floor means the minimum interest that we're going to see credited to our equity index product in any given year is 0%. So even if the S&P tanks and loses 20, 30, 40% of its value, we're just going to see 0% interest credit in that year. Our deposit amount is going to remain the same. On the other side, we'll have a 14% cap, which means the most our equity index product can gain in any given year is 14% interest. So even if the S&P rallies and gains 50 or 60% in a year, we're only going to see 14% of those gains. So we're kind of restricted to that range, 0 to 14. We're never going to drop, but we're never going to go above 14% either. And we'll compare that to a hypothetical investment in some fund that we'll pretend existed at the time that perfectly tracked the S&P 500. So if it goes up 50%, we go up 50%. If it goes down 50%, we go down 50%. And let's take a look at how that would have worked out during the Great Depression. We'll compare that direct investment into the S&P 500 versus an equity index product linked to the S&P 500. Put $100,000 in each, see where we end up in a couple years. So from 1929 to 1932, everything is terrible. Big drops every year. We got 52% down in 1931, 23% down in 1932. By the time we're in 1932, our initial $100,000 in directly invested into the S&P is down to less than $20,000. Our equity index product is just sitting there. We haven't had any interest credited to it because the markets have been down every year. The linked index has been down every year. But we haven't seen any losses either, so we're still okay. In 1933, we see a big rally. The S&P jumps up 66.8%. And our direct investment grows 66.8%, which is great, but it had shrunk so much that only represents about $13,000 worth of gains. Compare that to our equity index product. We don't get to participate in the full 66.8% jump. We only get 14% because that's our cap, but we get 14% of that $100,000. So we see $14,000 credited to our account. So even though that direct investment got to participate in the full 66.8% gain, it had taken such a battering beforehand that represents a smaller net gain than we see in the equity index product, which is limited to 14%. Next couple years, the S&P continues to do pretty well. By 1936, when it goes up 24.8%, our direct investment into the S&P has come back up to $59,883. It's recovering well, but our equity index product is still way ahead. Because of that 0% floor, it didn't participate in those early losses. Even though it's only limited to 14% gains and it's not making the same kinds of jumps the S&P investment's making, it's making those gains in a steadier fashion, and it's up to 154,229. And the next year, 1937, when the S&P drops again down to down 32.8%, our direct investment is back down to 40 grand, and we're just sitting still in the equity index product at 154,229. The next year we recover a bit, up 28%, brings the S&P up to 51,509, equity index product up to 175,821. So over that period of time, our S&P investment lost about 50% of its total value. Our equity index product gained about 75%. So this really shows you how an equity index product can work well, especially during times of market volatility, because it doesn't participate in those losses. It just gets to sit those out and wait for the gains to start coming back in. For someone who's interested in reducing their exposure to market volatility, this is a very powerful illustration. Instead of just reducing your exposure to volatility, you can see how an equity index product in many ways makes volatility work in your favor. So I think we've got a good handle on what single premium life insurance is. We understand what the product does, the problems it can solve. We know that it can be issued quickly, underwritten easily, it pays great. Now let's spend a little bit of time talking about marketing and selling these things. Marketing single premium life insurance through direct mail is probably one of the more effective ways you can get started in the market. Whether you set appointments or set up seminars is up to you. For my money, seminar marketing is where it's at. It does have a little bit more of an upfront cost. There's some more legwork involved in getting a venue and all that sort of stuff set up. And you do have to have some level of confidence in your ability to speak publicly in front of a group. But you also get to give your presentation once to 20 people instead of giving it 20 times to one person apiece. It's a much more effective use of your time. If you're in a position professionally where seminar marketing is something you think you're comfortable with and that you can make work, I think it's the way to go. If not, one-on-one appointments can work. It's not quite as an effective use of your time, but like I said, it definitely can work. And to be fair, seminar marketing ends in appointments anyway. You're not going to be taking applications and checks for these single premium products at the seminar itself. You're going to be setting appointments. You're going to be meeting with these folks after the fact. And that's when you're going to be closing the deal and getting everything signed and paid for. So one way or another, you're going to end up at an appointment. Seminar marketing just gets a lot of the initial stuff out of the way and makes the closing process a lot smoother and easier because you've had that upfront bevy of information that they've had time to digest before the real one-on-one appointment. Regardless of how you're going into appointments and regardless of whether you're closing the appointments, everyone you talk to is a potential source of referrals, even if they don't buy something from you. A lot of times you'll get your best referrals from people that don't make a purchasing decision with you. So referral marketing should always be top of mind regardless of who you're speaking with. Identify your ideal client and then find people like them. That's the best way to build a solid referral chain that gets you working with the people you want to work with. I know it sounds obvious, when you write it out as a bullet point like that, find who you want to work with, then work with them. But that's the type of mindset you really have to have when you're going into referral marketing. It makes a big difference, and it's going to help you find the people that you want to work with more effectively and more consistently. If you've got an existing book of business, this is an even easier step because you probably already have an idea of your ideal client. Even if you haven't been marketing single premium life insurance to them, you know who you like to work with. You know the sorts of people you get along with. You know the sorts of markets you like to work in. Single premium life insurance doesn't have to mean you're taking $500,000 deposits. This stuff works with $25,000, $50,000, even smaller. You're still getting double leverage for your premium and your death benefit in most cases. You're still getting that effective wealth transfer vehicle. You're still getting that cash value growth. A lot of them are still going to have, even the much smaller ones, are still going to have some form of living benefits. So there's a lot there that you can do for people in a variety of different income brackets. I'm looking at a flyer right now from Oxford Life. It's touting a death benefit for a $25,000 single premium for, at age 55, 25 grand goes to $57,469 worth of death benefit. At age 65, it's $25,000 gets you $44,000. And this product issues all the way up to age 85. There's no medical exam or blood test. It's got the accelerated benefits that we've discussed, the living benefits in the event of chronic or terminal illness. You get all the benefits of life insurance. The death benefit's going to pass on tax-free and all that good stuff. There's loan and withdrawal features available. And this is a solid product. And you didn't have to put $100,000 or $500,000 into it to make it work. We're very privileged in that we get to talk to a lot of agents, and if you're like most of the agents we talk to, the single premium market is probably bigger than you think it is. It's a product worth looking into. It's a product worth adding to your portfolio. This is something that you can market successfully and sell profitably. And you can sell it quickly, too. Many carriers will issue these policies just a couple of days after nothing more than a telephone interview. Not a paramed involved for a lot of these. Quick and easy underwriting. Someone like National Western even will issue down to Table 5 with nothing but a phone interview. Getting contracted to sell these products is pretty easy as well. You can visit us at creativeinsurancepartners.com. We'll have a link below the video to do that. And shoot us a message, let us know where you're at, and we'll help you get the ball rolling. Don't just get contracted. We're going to teach you how to grow your presence in the single premium market. Those of you that might know us from our time with the Independent Life Insurance Agent Association and with MedicareTraining101.com, you'll know how seriously we take our agent development. We know, and you know our track record of taking agents from where they are to where they want to be. We're looking to do that specifically in the single premium market, and we want to do it with you. You also know that over the years we've harped on and on about what a good IMO is and what it means to be an upfront IMO and a decent human being in the insurance industry. So, of course, we're going to hold ourselves to all of that stuff now. An upfront release is available. You're going to understand your commission structure from day one. We're going to be completely transparent with you. We're going to do the best we can to earn your business. If we haven't convinced you yet, give us a call, shoot us a message, and let us do it in person. I promise we are really good at what we do. Thanks for joining us today and for listening to this presentation on single premium life insurance. Again, my name is Nick Perry with creativeinsurancepartners.com, and we're looking forward to talking with you soon.